Palo Alto, 2015. A young developer stares at a glowing smartphone screen in a dimly lit office. Digital confetti falls across the display as a stock order goes through. Zero commissions, free trading. It feels like a revolution. For decades, Wall Street gatekeepers charged $20 just to let you buy a single share of stock. Now, the gates are open. The velvet rope is cut. Millions of retail investors are pouring into the market, believing they have finally beaten the house. But behind the digital confetti, the house is not losing. In fact, the house is making more money than ever before. This is the paradox of the modern financial machine. You are told the product is free, but in the shadows of the market, billions of dollars are changing hands precisely because you clicked that glowing green button. There is no such thing as a free trade. When you do not pay for the product, you are the product. And your financial data, your micro decisions, your literal market orders are being boxed up and sold to the highest bidder in a game you do not even know you are playing. Let us step into a hypothetical boardroom in Silicon Valley to understand the genesis. The venture capitalists are staring at the founders of a new, disruptive brokerage app. The lead investor asks, "If we do not charge our users a commission, how exactly do we keep the servers running?" The founder smiles and replies, "We do not make money from the users. We make money from the market makers. We take the millions of orders our users place, and instead of sending them to the New York Stock Exchange, we sell that pipeline of orders to massive quantitative trading firms. They pay us for the privilege of executing the trades." The investor leans forward, eyes narrowing. "So we are a broker that does not actually use the public stock exchange?" "Exactly," the founder says. "We bypass the public market entirely." This is the hidden architecture of payment for order flow. And if you want to truly understand how modern wealth is extracted, you need to look past the user interface. By subscribing to this channel, you are joining the few who understand the system, who look at the machinery of capital and see the gears turning. Imagine a giant transparent water pipe representing the public stock market. For over a century, if you wanted to buy a stock, your order flowed into this main pipe. Everyone could see it. Buyers and sellers met in the open, creating a transparent public price. But payment for order flow fundamentally alters this plumbing. Picture a secondary, opaque pipe branching off right before the public exchange. This is where your broker diverts your trade. Instead of routing your buy order straight to NASDAQ, your retail broker routes it to an off-exchange wholesaler, a massive proprietary trading firm. This wholesaler pays the broker a tiny fee, literally fractions of a cent per share, to intercept your flow. The mechanism is completely legal under Securities and Exchange Commission rules, provided the broker claims they are securing the best execution for you. But the reality is a structural diversion of liquidity. Your green buy orders leave the brokerage app, never reach the public market, and instead pour directly into a corporate black box. The lit exchange is starved of your trade, while the private wholesaler feasts on the guaranteed volume. The sheer scale of this diversion is difficult to comprehend until you look at the balance sheets. The narrative sold to the public was one of democratization, the idea that zero commission trading was leveling the playing field for the average citizen. But the math tells a much darker story. The very mechanism that made trading free was simultaneously transforming retail investors into a captive commodity. The brokers were not acting as your agent on a public auction block. They were acting as wholesalers, packaging your financial intent and auctioning it off in dark rooms. And as this model exploded in popularity, driving millions of new accounts and unprecedented daily trading volumes, the primary buyers of this order flow realised they had struck the ultimate goldmine. One specific firm stepped up to buy almost all of it. They recognised that whoever controls the retail order flow controls the invisible spread of the entire market. The question is no longer why trading is free. The question is, who is willing to pay billions of dollars just for the right to trade against you? Chicago 2024, the Citadel Securities trading floor. The air conditioning hums violently to cool rows of black server racks processing millions of calculations per microsecond. There are no shouting men in colourful jackets here. There is only the low, continuous drone of automation dominating the American financial system. Citadel Securities sits at the epicenter of this new reality, operating as the undisputed king of off-exchange market making. To grasp the sheer gravity of this room, look at the regulatory filings. Between April and December of 2024 alone, this single firm paid roughly $732 million for retail options order flow, and another $219 million for cash equity order flow. That is nearly $1 billion paid out in just 9 months, strictly for the right to internalize retail trades from 5 major brokerages. Visualizing this requires abandoning the idea of a stock market. Picture instead a vast industrial refinery. Citadel is the refinery, and the retail brokerages are the oil derricks, pumping a continuous stream of crude data directly into their proprietary algorithms. Why would a hyper-sophisticated quantitative firm pay billions for the trades of amateurs? Let us script a conversation between a wholesale market maker and a hedge fund manager to expose the logic. The hedge fund manager asks, "Why are you paying Robinhood hundreds of millions a year for their trades? I will give you my institutional order flow for free." The market maker shakes his head and replies, "I do not want your flow. Your trades are dangerous. When you buy 1 million shares of Apple, you are doing it because you know something. You have private research. If I trade against you, I will lose money because the price is about to move." The hedge fund manager frowns. "And the retail trader?" The market maker smiles. "The retail trader knows nothing. They buy 50 shares because they saw a post on the internet. Their trades are uninformed. They do not move the broader market. That makes them perfectly safe to trade against. I will gladly pay for the right to guarantee I am only trading against the blind." In the vocabulary of market microstructure, retail flow is classified as uninformed or non-toxic flow. This is the cornerstone of the internalization machine. When an institutional giant places an order, the market reacts, prices shift, and the market maker takes on massive inventory risk. But when you place an order for 10 shares of an index fund, your trade has absolutely zero informational edge. The wholesaler sees this flow and perfectly fills those orders against its own massive internal inventory, or simply hedges the exposure momentarily on the public exchanges. They capture the bid-ask spread, the tiny gap between what buyers are willing to pay and sellers are willing to accept. It is a game of fractional pennies. But when you process billions of shares a day, those fractions compound into billions of dollars in risk-free profit. Imagine a toll booth on a highway. The toll is so microscopic that no individual driver notices it. But if you own the toll booth and you force 40% of the country to drive through it, you become an empire. The concentration of this power is entirely unprecedented in financial history. A widely cited Bloomberg analysis of market structure reveals a staggering reality. Wholesale market makers execute the vast majority of all retail equity volume in the United States. And Citadel Securities alone handles over 40% of that total flow, dwarfing competitors like Virtue Financial and 2 Sigma. A single private entity acts as the counterparty to nearly half of the retail trading public. They defend this practice fiercely, arguing that they provide massive price improvement for retail investors, filling orders faster and slightly better than the quoted public prices. The math, they claim, proves they are a net benefit to society. But as this dominant pipeline grew, academics and regulators began running their own diagnostic tests on the data. When the pipe is entirely private, the water only flows where the architect wants it to. And deep within the execution logs of these free brokerages, investigators were about to discover that the invisible toll booth was charging a much higher price than anyone realised. A suburban basement in Ohio. The timestamp reads 9:30 in the morning, the exact moment the opening bell rings in New York. A retail trader sipping coffee clicks buy market order for 100 shares of a tech stock. In the fraction of a millisecond it takes for him to blink, a vast invisible journey occurs. His order never travels to Wall Street. It travels through fibre optic cables to a server farm in New Jersey, straight into the waiting algorithmic maw of an internalizer. This is the golden age of the spread capture mechanism. The lit exchanges, the famous boards of NASDAQ and the NYSE, are entirely absent from this transaction. The market maker receives the electronic signal, processes the trader's intent, checks its own vast internal ledger, and instantly executes the trade from its own private inventory. The trader's screen flashes a green confirmation message. He feels the rush of participation. He believes he has interacted with the global economy. In reality, he has only interacted with a highly optimized reflection of the market, generated by a private corporation. Let us break down the exact mathematics of this encounter through the perspective of the algorithm itself. Picture two developers coding the internalizer logic. The junior coder says, the public market shows the stock is available to buy at $10.01 and to sell at exactly $10. A retail buy order just arrived. The senior architect points to the screen. Good. Do not send it to the public exchange. We will act as the seller. We will sell him the shares at $10.00, plus half a penny, 10.005. The junior coder is confused. Wait, we are giving him a slightly better price than the public exchange? Yes, the senior architect replies. That is called price improvement. It keeps the regulators happy. But because we bought the stock from another retail seller moments ago at $10 flat, we just locked in half a penny of pure profit with zero risk. Now, repeat that action 10 million times before lunch. This is the three-step architecture of payment for order flow combined with internalization. Step 1 is order capture. The broker legally sells your order to the wholesaler, physically diverting it from the public exchange. Step 2 is the first look and spread capture. The wholesaler gets an exclusive first look at your order and compares it to the national best bid and offer. They fill you at or slightly better than the public price, while simultaneously adjusting their own positions on the lit markets based on the aggregate data they are seeing. The profit is generated by capturing the spread and leveraging the informational edge of seeing the entire retail pipeline before the rest of the market. Step 3 is the rebate. The wholesaler kicks back a per-share fee to the broker, effectively funding the illusion of free trading. Visualize a pie chart representing the total profit in a trade. The wholesaler takes the largest slice for providing the infrastructure. The broker takes a small slice for providing the user, and the retail trader is left with the crumbs. This three-step loop is so ruthlessly efficient that it has fundamentally rewritten the topography of American finance. A comprehensive paper by the CFA Institute on dark pools and internalization came to a chilling conclusion. They estimate that internalization accounts for almost 100% of all retail marketable order flow in US equities. I want you to let that sink in. Nearly every single small marketable order placed by a retail investor is being bought and sold in the shadows. The public market, the bustling ecosystem of buyers and sellers determining the fair value of a company, is a ghost town when it comes to retail participation. The internalizers have walled off the entire demographic. But as this golden age of frictionless profit reached its zenith, a fatal flaw in the system began to surface. When a broker's primary revenue stream comes from selling its users to a third party, the broker's loyalty inevitably shifts to the buyer. And the definition of a fair price was about to be put on trial. Washington, D.C., late 2020. Deep inside the headquarters of the Securities and Exchange Commission, a team of enforcement analysts are staring at digital execution logs bleeding red across their monitors. They are forensically reconstructing years of trades originating from the most popular retail brokerage app in the country. The math simply does not align with the marketing. Robinhood's entire brand identity was built on the promise of democratizing finance, allowing the little guy to trade without paying the traditional commissions that enriched Wall Street. But the data on the screens tells a contradictory narrative. The analysts discover that between 2015 and mid-2016, payment for order flow comprised more than 80% of Robinhood's total revenue. The brokerage was not merely dabbling in this controversial practice, they were entirely dependent on it. And more disturbingly, the rates they were charging the wholesalers for this flow were unusually high. The SEC realised they were not looking at a tech company disrupting finance. They were looking at a lead generation tool for high-frequency traders. To grasp the severity of the conflict, imagine an interrogation room where an SEC regulator sits across from a brokerage compliance officer. The regulator drops a massive file on the table. Under US law, you have a strict duty of best execution. You must find the best reasonably available terms for your customers. But you sold their orders to the highest bidder. The compliance officer crosses his arms. We did not break the law. We saved them millions in commission fees. Trading was completely free. The regulator leans forward. It was not free. Because you demanded such massive kickbacks from the wholesalers, those wholesalers gave your customers terrible fill prices. The customer saved a $5 commission, but lost $10 on the hidden spread of the execution. You knew your exceptionally high payment rates were resulting in inferior prices, and you did nothing to stop it. The compliance officer remains silent. The illusion shatters. The true cost of zero commissions is finally articulated out loud. The broker had prioritized its own rebate over the client's financial outcome. The legal framework governing this system hinges on a concept called best execution. Brokers are legally permitted to accept payment for order flow, but SEC rules explicitly state that these payments cannot interfere with the obligation to get the best possible price for the customer. Brokers must rigorously and routinely review their execution quality. Think of it like a real estate agent. If your agent tells you they found the best buyer for your house, but secretly only showed the house to a buyer who promised the agent a massive under-the-table kickback, they have violated their fiduciary duty. In December 2020, the SEC charged Robinhood with misleading customers about its revenue sources and failing to satisfy this exact duty. The enforcement order was devastatingly clear. From September 2016 to June 2019, Robinhood failed to conduct adequate reviews of its execution quality. They knew their unprecedented payment rates could result in worse prices for their users, yet they maintained the system. The free app was systematically draining value from its users in micro increments. The financial penalty quantified the exact cost of this illusion. The SEC concluded that Robinhood's conflicted order routing led to a collective customer harm of approximately $34.1 million in price differences. And crucially, that $34 million loss was calculated after accounting for the money users saved on zero commissions. Free was mathematically more expensive than paying a traditional fee. Robinhood paid a massive fine to settle the charges, but the structural revelation sent a shockwave through the broader financial industry. The regulators had proven that payment for order flow could easily become a mechanism for systemic wealth extraction. But the fine did not kill the practice. It merely forced the industry to become more sophisticated in how they justified the spreads. The pipeline remained open, and the wholesalers continued to consume the retail flow. But the damage to the market structure was already done. We were about to discover that when you siphon off half the trading volume into dark, private networks, the entire concept of a public stock market begins to collapse. A windowless data center in Secaucus, New Jersey, 2021. Miles of blue Ethernet cables connect proprietary trading servers directly to the matching engines of the major exchanges. This is where the physical reality of the dark market exists. SEC Chair Gary Gensler is preparing to testify before Congress, holding a dossier that reveals a terrifying structural truth about American finance. The lit exchanges, the public order books where price discovery is supposed to happen, are being starved. When you strip away the marketing, the reality of the US equity market resembles an iceberg. The public only sees the tip, the lit volume traded on transparent exchanges. But beneath the surface lies a massive, obscured structure of dark pools and internalized order flow. Every time a retail investor interacts with the market, they are feeding the dark side of the iceberg. The public tape, the ticker symbols crawling across news networks, represents an increasingly distorted fraction of actual human economic activity. The market has been bifurcated into a lit venue for the institutions and a dark box for everyone else. The consequences of this bifurcation are best understood through the panic of a traditional institutional investor. Let us script a phone call between a mutual fund manager and a prime broker. The manager is staring at a flatlining stock chart. I am trying to buy 50,000 shares of this mid-cap stock, but there is absolutely no liquidity on the exchange. The public order book is empty. Where did all the volume go? The prime broker sighs into the phone. The volume is still there. It is just off exchange. The wholesalers are internalizing 40% of the daily trading. They siphon off all the easy, non-toxic retail orders into their own private pools. The manager raises his voice. If they are taking all the easy trades in the dark, that means only the most aggressive, toxic trades are left on the public exchange. That destroys our ability to price the asset fairly. The public price is becoming a mirage. I know, the broker replies coldly, but they pay for the privilege, and we do not. This is the mechanism of price discovery degradation. A public market functions efficiently only when a diverse mix of buyers and sellers interact openly. Trades internalized by wholesalers, or executed in dark pools, are eventually reported to trade reporting facilities, but often with a crucial microsecond delay. Regulators stress that this is not technically illegal front-running because the wholesaler acts as the direct counterparty. But critics argue the aggregate effect is a systemic informational disadvantage. The CFA Institute's survey estimates that off-exchange volume accounts for roughly 40% of all US equity trading. When you remove almost 100% of retail marketable orders from the lit exchanges, you siphon off the smoothest, most predictable liquidity. The public exchange is left with only the sharpest institutional algorithms fighting each other. Picture a river representing market liquidity. If a private corporation builds a dam and diverts half the water into an underground reservoir they control, the public river slows to a trickle. The ecosystem downstream begins to choke, and true price discovery breaks down. SEC Chair Gary Gensler eventually dropped the bombshell publicly, telling Congress that nearly half of all trading interest in the equity market was either in dark pools or internalized by wholesalers. The American financial system, proudly touted as the most transparent and robust in the world, was operating primarily in the shadows. The realization that a handful of ultra-fast market makers were legally trading against the public in private, one fraction of a cent at a time, sparked outrage. Retail traders realized their free apps were essentially data extraction tools. The US regulatory apparatus defended the system, pointing to the fractional price improvements provided to users as proof of efficiency. But as the American debate raged on in endless congressional hearings and academic papers, international observers were watching with sheer disbelief. Because while Wall Street fiercely defended the necessity of payment for order flow to maintain zero commissions, the rest of the developed world had already analysed the exact same mathematical conflict and arrived at a drastically different, unyielding conclusion. London, the headquarters of the Financial Conduct Authority. 2023. A senior regulator firmly presses a red stamp onto a comprehensive policy document. The directive is absolute. Across the English Channel, the European Securities and Markets Authority in Paris is circulating the revised Markets in Financial Instruments Directive, known as MiFID II, and preparing for the rollout of MiFID III. The air in these European boardrooms is devoid of the American obsession with zero-commission marketing. Here, the focus is entirely on structural integrity. Global trading reports note a glaring geographic divide. Large market makers are paying billions to access retail orders in the US, a controversial practice that is strictly banned in most countries outside America. The European regulators look at the American model of payment for order flow not as an innovation, but as a catastrophic failure of fiduciary duty. They recognise that a system where a broker is paid by a third party to route client orders creates a profound, irreconcilable conflict of interest. In the eyes of the global community, the American market structure is fundamentally compromised. Imagine a tense summit between an American brokerage executive and a European financial regulator. The American executive is trying to expand his zero-commission app into the European Union. Our platform is revolutionary, the executive pitches. We eliminate trading fees entirely by utilizing payment for order flow. We democratize the market for the working class. The European regulator shakes her head flatly. Your model is illegal here. You cannot serve two masters. It is mathematically impossible to secure the absolute best execution for your client while simultaneously accepting a kickback from the market maker executing the trade. The executive protests. But we provide price improvement against the public benchmark. The regulator interrupts. Your benchmark is corrupted because half your market is hidden in dark pools. In Europe, we require orders to compete on lit exchanges to ensure true price discovery. If you want to operate in our jurisdiction, you will route your client orders to the public market, and you will not accept a single cent in hidden rebates. The American model is denied entry. The global perspective demystifies the American illusion. The UK's Financial Conduct Authority has aggressively stamped out PFOF, stating it is inherently incompatible with the rules of fair dealing. In the EU, the regulatory interpretation effectively prohibits these routing kickbacks entirely. By banning PFOF, these countries force retail orders onto public lit exchanges. This mechanism naturally thickens the public order book, tightening the bid-ask spread for everyone through pure competition, rather than relying on the benevolence of a private wholesaler to grant artificial price improvement. Visualize two different auctions. In the European auction, all buyers and sellers stand in the same brightly lit room, shouting their prices. The fairest price naturally emerges. In the American auction, retail buyers are blindfolded and led into a soundproof side room, where a single corporate entity dictates the price they receive, based on what maximizes the corporation's own profit margin. It is a stark contrast between a market designed for public utility and a market perfectly engineered for private extraction. The architecture of payment for order flow is not merely a technical loophole, it is the defining blueprint of modern financial extraction. Citadel Securities handling 40% of all US retail volume, paying $1 billion in just 9 months to intercept your trades, is not an anomaly. It is the intended result of a system that views the working class investor not as a participant, but as a high-frequency data stream to be harvested. The systemic threat is absolute market capture. As long as the pipes remain dark, the lit exchanges will continue to wither, and true price discovery will vanish completely into corporate black boxes. The paradox of the free trade is the ultimate sleight of hand, costing you pennies on every execution, billions in aggregate, while convincing you that you are winning. The machine relies entirely on your blindness to its mechanisms. Do not let your wealth be internalized in the dark. Subscribe to this channel, study the underlying architecture of capital, and prepare yourself. Because the true cost of free is a market where you are no longer the player, you are only the prey.